Hello and welcome to the monthly market update for March 2019 from Kotak Wealth Management. With us today, we have Mr. Neelesh Surana, Chief Investment Officer for Mirae Asset Global Investments. Neelesh, welcome. Thank you for joining us today.
Thanks, Apurva.
Neelesh, we are now in the run-up to the elections, and every time over the last several instances, we've noticed that the election turns out to be a key catalyst for the market, leading to a lot of volatility either before and, of course, in some cases even afterwards. What is your anticipation as we get into election season this year?
No, if you look at the past trends, I mean, barring, I think, 2004, extreme volatility has never been there in election, around the election period. And also, there are a few things to be kept in mind. One is, during this time, we are coming out, the corporate India is coming out of a period where the profitability has been on the lower side. I mean, if you look at profit to GDP of, say, 500 companies, it's around 2.8, less than 3%. The 15-year average is north of 4.5%, 5%. So whether it is ROE or profit as a percentage of GDP, it's low because of certain sectors which are turning around. So to that extent, the base is low and the expectations for earnings are low. So in that context, while there could be some volatility, we don't see significant volatility and a meaningful impact of election on sort of markets. And lastly, I think the political narrative has changed over time. I mean, whatever parties may say pre-election, post-election, I think fiscal consolidation, growth is very important for the progress of the country, for job creation, for the rating of the country. So to that extent, in the current scenario, we don't think so that election would have a significant impact in terms of the returns, while there are noises, of course, otherwise.
You know, let's talk about FPI flows. Last year was very visible where FPI flows were particularly low, in fact negative. Yeah. This year they've been hugely positive, especially for the month of March. And I think the cumulative number for CY 2019 is in excess of $6 billion now. Yes. Do you think these flows are coming to India largely because of US's patient stance on rate hikes? Or do you think there is genuinely now an interest in emerging markets globally?
No, so Apurva, let's break it into two parts. One is, as you rightly said, the near-term outlook and what happened last year and longer-term flow trend. In the near term, you're right. I mean, we have year-to-date, calendar year-to-date, we have attracted almost $7 billion, and that could possibly be because of two counts. One is probably the election narrative has changed compared to some amount of anxiety at the start of the year, and second is what you alluded to, that the dovish stand of the Fed or the growth trends in the global economy are not so strong, which is always advantaged steadier markets like India. So that's on the sort of near-term trend. But when you look at a more longer-term trend of FII flows, I mean, if you look at since 2000, we have collectively got about north of $140 billion, so roughly about 15 billion every year. There has been exceptions and there have been far and few. 2008 was one exception, large outflow for the reasons known. Some blip in 2011 and of course in 2018 again, about minus 4.7. But our view is that over the time, more than the longer term, India would continue to get good FII flows. The timing of that or the quantum of that is very, the core portion of it is very difficult to sort of time it.
You know, there is this belief, and of course I think we've seen this happen also, that after SEBI's recategorization initiative for mutual funds last year, a lot of mutual funds have significantly underperformed their benchmark. Yeah. We actually did a study where in the last calendar year, we saw almost 94% of funds underperforming their benchmark. Do you expect going forward mutual funds to continue generating alpha as time goes by?
No, so the debate is right that particularly last 1 year and particularly on the larger cap funds vis-a-vis ETF, etc., there has been a bit of underperformance. I mean, if we talk about our fund house, we are outperforming even on 1 year or a 2 year basis. But yeah, there is an observation, there is a significant underperformance vis-a-vis the benchmark. I don't think it's to do with SEBI reclassification of the categories. It's more to do with the fact that the benchmark has been polarized to 4-5 names and they have very heavy weights, and anyone who is not fully appropriate weight on those names, that created a bit of significant sort of underperformance. So having said that, if you look at 15-20 year sort of returns of mutual fund or the period prior to last 1 year, 2 years, we have seen I think enough long-term track record of active money outperforming the benchmark. So we would take it as an aberration, and we would think that over time active funds on aggregate will outperform the benchmarks. Yeah.
Thanks, Neelesh. Neelesh, there is this notion that over longer periods of time that equity markets broadly track nominal GDP growth. And I think we've seen it happen time and again that nominal GDP has been a good proxy for expecting equity market returns. Now, nominal GDP has obviously come off in the last couple of years, especially because of low inflation. Going forward, do you expect this to remain a benchmark for expecting returns from equity markets?
Yeah, but I mean, if you put the overall number in context, we are talking of the real growth itself being around 7.5% or so. So it doesn't move the needle significantly on the on that. And what is advantage of lower inflation is also one of the factors in terms of where the interest rates are. So to that extent, the valuations are also inversely proportional if you have more benign interest rates. So I don't think so that just because a slight reduction in the nominal GDP growth would anyway impair the trajectory of returns, given the fact where the economy is, where the growth prospects are. I mean, the fact remains that long way to go for us in terms of doubling the economy over the next 6-7 years and further doubling over a similar period of time. And to that extent, earnings will grow in similar pattern, and so should be the returns here.
Neelesh, as you can see from this chart, clearly earnings in equity markets in India have come out of a fairly prolonged period of recession. Every year for the last few years, the expectation is that earnings will improve. Do you think we finally turned the corner on corporate earnings? Is there optimism going forward as we get into FY20?
Two things. One is, like many a times, portfolio earnings obviously need to be differentiated from the index earnings, which are much talked about. You're right, over the last 8-9 years, there's been, I mean, if you look at it, we never had a very high period of earnings growth. And as we look today, we are talking almost north of 25% earnings growth in FY20. And that, the confidence is very high because it is much more to do with bottom-up cases in certain sectors which are turning around. In case in point, obviously, is corporate banks. So corporate banks is doing the heavy lifting, and they are coming out of a period where a lot of NPAs were there, and they are turning around, and there is enough commentary confidence in terms of it would the glide path of turning around in FY20 and full impact in FY21. That's one. Second is, the base is also low for some of the aberrations in the indices, maybe telecom, how much worse it could be. Pharma has its own sort of challenges. Again, base is sort of favorable. Private capex is missing. Again, the base is sort of favorable. And also the fact that the consumption side of the economy also was not a full-blown sort of strong trend over the last couple of years, because it got impaired initially by demonetization and some of the reforms related to GST, RERA, the NCLT and the liquidity crisis. All that is in base. So to that extent, the confidence when the base is low for earnings to revive is pretty high. So I think F20 should be seen in the light where the base is lower. So we are seeing a number high of 25% or so. Beyond that, we are fairly confident we go back to mean in terms of earnings close to 14-15%.
Thank you, Neelesh. Thank you so much for joining us today. It's a pleasure having you with us. Thank you for joining us. Please write in to us with your feedback and suggestions. We look forward to seeing you again next month.